Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, August 9th, 2022. It's 10:18 Eastern Times. I'm starting the video, so we've been trading for about 45 minutes. Just want to do a quick update, take a look at where we are, where we might be going from here, and updates on some of the recently highlighted trade ideas. So I'll try to hit on what I'd like to do is start out with equity markets, as I always do. Want to do an update on lumber and some of the commodities. Might skip precious metals in here. There's no change today or anything big worth noting. So let me just start out with the equity markets. All right, so far a perfect rejection off that 200. Remember that, so we pretty much hit my minimum, what I'm going to call max bounce targets. I give you a max bounce target zone for this bear market rally. That was when we were at the, reversed off those lows on the 16th of June. And said the downtrend line and or these 200s which came in with it, the 200-day exponentials right there, that red line, and there's the 200-day simple. No guarantees we can't go any higher, but like I said before, that pretty much meets the the low end of my maximum bounce target. What I mean by the maximum bounce target, but my terminology is confusing. There was a tradable, some tradable pullbacks along the way. So again, as an active trader, those were pullbacks to be gamed. I mean, heck, I'll talk on active trading here in just a second. We get down really granular, looking at the 5 and 10-minute charts. That's where the real active trading happens. But again, it's all relative. I know if I sound like I'm rambling, there's active swing traders I refer to. A swing trade is typically something you hold for days to weeks, sometimes months. There's no hard definition for it. So when I say less active swing traders, those are the ones that are going for these, that aren't going to go in and out every day, try to capture the bulk of these trends. And then the active swing traders will go down, at least for me, down to those 5-minute charts. And there's kind of a blurred line between active swing trading and day trading, because sometimes just by the nature of these trades, they hit their targets within the same day. So I'll get to that in a second. But all right, just the kind of the takeaway is that may be it. It may not be it, but we're about seeing what I've been looking for, and talked about for all the way up. A paradigm shift, and I'm seeing it clearly in the headlines, where now all the clamoring for the new bull market, all the Nasdaq, and they're focusing, of course, on the Nasdaq, not the S&P now, which they usually cite S&P for bull and bear markets. Headlines I've been seeing from Barron's and the Journal and everywhere else is, if we can just pop up another 1% from where we closed the highs yesterday, we'll hit the official bull market territory in the Nasdaq 100. And I told you, I don't know when these people are going to give up on these antiquated methods of bull and bear markets, being a rise or fall 20% off the highs and lows. If that's the case, you have bull and bear markets almost every week in natural gas, all the time in things like lumber and volatile commodities. And we've had plenty of bull and bear markets then. But to me, and I've maintained it, we're just still in a bull market that started back in the Nasdaq 100 in 2008, and when we bottomed there in November. And there's our bull market uptrend line. So things are just more volatile nowadays, and especially when you're trading a higher beta index like the Nasdaq 100 full of tech stocks. 20% rips and dips are normal. We've had multiple since that 2008 low, but if you don't have to be an expert in charting to look at that and say that's a bull trend. So call it whatever you want, semantics really. But the key is we hit, by the way, not just that 200-day, as I mentioned before, major Fibonacci cluster. I've got it somewhere. There it is. The 38.2 and 50% Fibonacci retracements. That's off the all-time high, the big drop, the full drop so far, as well as that major reaction high and that subsequent drop there, and that's what we call Fibonacci cluster. It's resistance. So on a 1 to 10, it's about a 10 as far as an objective shorting level. And the fact that the media had just shifted to just all-out bullishness lately. We're back here. I cited one of the reasons among many, technicals first and foremost, but the sentiment was absolutely a large factor. I cited the surge in recession, search hits, the all-time high uh, buzz about recession. Not are we in one, but how bad's it going to be, and how much lower is the market going to go, and all these articles coming out on how to hedge up your positions and what to do and all that. So, anyways, we've come full circle. The paradigm shift is now in full play, full swing, and in a bear market, that's usually about it. So. That's all I want to say. Then we can go up more, but I'm open to the possibility that that may be it. So if you've been shorting or shorted in the last week or so, you may have just, and especially if you were long, which you should have been off that low. I think the case was pretty persistent and made along the way. Then you may have just nailed the exit on those longs and nailed the entry on the shorts. We'll see. Time will tell. PPO crossing over at a high level here. You can see that on the daily chart. I look for those bearish PPO crossovers. They're pretty good trend indicators, especially high level like that. You want them above the zero line, and you can see all these. We had one there too. Major tops were all marked by those. So a lot of evidence there that says the end of the run may be over. So we'll see. All right, let me just walk it down to the shorter term time frame. Let's do 60-minute chart. There's that wedge on the Nasdaq 100 QQQ. Broke down there, a little snapback, back test, put in a marginal new divergent high. And here's where I want to do the video. There was, and that is still support right there, pretty good support, 314.65. Probably get a reaction there, but we could also get a reaction right where we're at right now, and that's what I want to do the video, get it out to you guys. Remember, just the other day, let me show you that. Well, the other day is in yesterday. Gave you the 60-minute charts of QQQ, NQ, IWM, small and it's the Nasdaq one, like usual, the Nasdaq 100 and the small caps that I'm focused on and trading right now for indexes. But so this chart here has just been this is an active trader's dream, and there's just this thing's printing money lately. The market's been, it's been a good year, and it's trading well to the technicals, at least the way I trade. I'm not always in sync with the markets, and when the Fed flooded the market with liquidity, it's tough when you're going up and there's no resistance levels. But during a correction or even a rally that's back into levels where there's already been a lot of resistance levels to look at, that's where my style of technical analysis will shine. My abilities have been lying in, skill sets lie in identifying key support and resistance levels that are likely to come into play, and that means bounce. You can trade bounces off of, or wait if you think it's going to go. So this was that chart the other day, and I'll zoom in a little tighter if I can, but I don't think I can. It's bouncing. It's zoomed in on the site. But so you had the first little wedge there. There was sell signal 1 break. There was a secondary trend line there. Your second sell signal hit that level, and then we had this suggested this primary up or secondary uptrend line, and that said would trigger the next sell signal, as well as that 233.68 level right there, and then had us go into 13.103. With a reaction. That's what an arrow break. I can't draw all the squiggles. There's not enough room. And then 12, that is 12,984. So 13,103, 12,984. Let's look at that chart now and show you how you can trade off those. There's the break. That sell signal would have got you short or had any longs yesterday. Hit that 13,103. Bounce. It was about a 1% bounce. Right back perfectly to that resistance level. These have not been modified. Now, see, for an active trader, that's only about 1% bounce. You might say, oh, that's not worth it. But if you trade NQs, for example, 20 contracts of the NQs, although you don't need to put a fraction of this up, you can have less than $1 million account, and it gives you 20 contracts is $5.2 million in net exposure. So 1% on bounce, if you gain a 1% bounce in the market, that's a $52,000 gain. So you can cover your short there. You make $52,000, cover your short bounce, make another $52,000. It's $100 grand. Go back in short and hold for the next target, which is just hit. And that's where I'm going, and cover that short, which from there to there, on 20 is 100 grand. Now let's just talk. Okay, everybody doesn't have $1 million account. Some have more, some have less. So you trade. Half of 20 contracts in the NQ would be 10, of course, and that'd be about a little over $2.6 million. You cut it down. You go one contract, one single contract and you're still talking thousands of dollars in just a single contract of NQ. And if that's still too much for you, then you have the MNQs, which are 1/10. It's the same exact price levels of these charts I give you on NQ, but they have a smaller multiplier, which is basically your leverage factor. So it's 1/10. So there's pretty much something for everybody. Over the years, I've migrated more and more towards futures for the fact that they trade around the clock, and that's what I really like, is that I can go to sleep and I know it's 3 in the morning if there's a huge move because Putin fires some missile and it hits the wrong place, and the futures are plummeting over in Europe, which causes our futures to plunge. I can get stopped out and not wake up to a big 3% gap down against a position. And likewise, if my price target's hit at 3 in the morning, I don't have to be around to do it. That's one benefit. The other, of course, is taxation. That's a big one for me and some people. It's 60% long-term capital gain, 40% short-term gain, which is a huge saver in tax rates. Let me promise you guys are only going up from here. We've got a spend government, big green agenda being pushed, corporate tax rates. I can almost assure you that personal income tax rates, especially on the middle to upper middle class, are going up. So down the road, it's going to be a big factor of short-term gains. In other words, if you're trading, actively trading, you should know this, that all your gains are short-term gains, which are taxed as ordinary income. Highest tax bracket being 37% right now. All right, and that's it. So it's simple stuff. And look, and if you take a shot, you don't always just take a shot just because it's resistance. You look at the 5-minute charts, the 10-minute charts, the shorter term. This is a 60, and you game a bounce, and you're not always going to go back into resistance. You can do that. You certainly, on something like this, that's where you'd have a sell limit order if you're reversing here at 12,984. Sell limit order just shy of that level in case the sellers step in early. They'd hit it perfectly here on multiple occasions, but now what happens? We're getting to what I call the POR, point of recognition. Another one of those 1,000,001 terms I've made up in the market. Point of recognition is where the bulls realize it's that rut row moment. They've been buying the dips. Hey, dip buying works. Dip buying is great. See, I buy the dips, and I always get bailed out. And then they start buying the dips, and they realize that they're buying the dips back to support, but it's no longer working. And the point of recognition was they realize that their strategy, after they've had several losses and their gains are evaporating, or they were JCL longs, meaning Johnny come lately, they didn't want to buy here, but they wanted to buy here, or mostly right here. That's where you get most pile in at the top. And then they're underwater, so they're not just giving back profits from here, they're giving back they're seeing losses rack up. Anyway, so where I'm going with that is you tend to then get fewer reactions. You could slice right through a level. You have a little minor reaction in time. So it's these early reactions. You usually get the full bounce back to resistance, and then it gets a little tougher as you go here because you start to, at some point, you get more of a waterfall type sell-off as more and more stops on long side traders get hit, and more of those longs, if they don't have stops, they just kind of puke up those shares, metaphorically speaking. That's when you can't take the pain anymore, and you cut out. So where does it go? Where are we going here? Let's look back here, and the same targets we're looking at. These are minimal swing targets. This is messy on NQ. Let me go back to QQQ. I have so many micro levels there. QQQ still looking at a pretty decent chance before a tradable bounce, swing tradable bounce. If you want to say, forget about that active trading stuff, Randy, maybe someday, and that's fine. Cut your teeth on, regular traditional swing trading, especially if you can't do this full time. There's no way you're going to actively trade if you work a job and you're trying to sit there on your iPhone and or sneaking in on your computer when your boss isn't looking. You're just going to lose money. Just focus then on swing trading, trying to capture the trends. Use OCO orders. If you got in short here recently, you can have a stop. This is really where we shouldn't go. That's big resistance. If we get another up, that's still, I'll be talking the same bearish talk that I'm talking right now about shorting, objective short entry, unfavorable to being long, if we have one more thrust up, because that's big resistance, that 330 and the downtrend line. And but why didn't I wait for that? Because all eyes must see it. And, it's a very obvious downtrend line, those Fibonacci levels. So I'd rather be in a little early than a little late. By getting in early, if we reverse and that's it, and we never get there, then fine. If I get in early, I go a little underwater. Which I did on this one. I started getting in here. I told you guys scaling in as swing positions, but the active trading in my active trading account, that's any one time if I'm long or short something in IRAs and longer term accounts, then I could be the have the opposite side of that trade in an active trading account. So that's it. I wanted to show you that the targets I gave you, that 314.65, may not get hit because the fact that NQ is at support. So that's where I think it was worth reversing. All right, I didn't mean to get off those. Well, let me just cover, because I've been harping on RTY or IWM lately too. Nothing's changed there. That's still the same setup it was. This is what I call another term. I call it a wedge overshoot or wedge overthrow when you have a bearish rising wedge. And whether you break down first, we had a couple whipsaws here, but we had the overshoot. Like I said, I certainly stuck with that trade. And when you have an overshoot, what happens? You come back down through the wedge, and from my experience, they're usually pretty powerful moves because it's a big old fake out. It's the bulls think, oh, that wedge isn't going to play out. Shorts got squeezed out, weak-handed shorts, and so you have a lower short interest at that point. And that low short interest is what you want if you are shorting. You want to be a lone wolf. You don't want to be with the crowd because if everybody else is shorts are, I've always said, the only, and I'll repeat, the only guaranteed buyer in the financial markets of a stock or security, because a short seller must cover his or her position at some point. You could be foaming in the mouth bullish, talking the bullish talk. Oh, I have all this, hedge fund manager, let's say, with a lot of cash to deploy, and I plan to buy IWM, load up on the small caps. That's rhetoric, but at some point you may change your mind, decide not to buy. So you're not a guaranteed buyer. You're a potential buyer. Short sellers are guaranteed buyers. They will and must cover at some point. So what happens is in a trade, if you have a lot of short sellers, as a stock goes down, along the way, more and more of those short sellers are going to cover, and they also have the potential they can get squeezed if it goes the other way. So that's why one reason I'm so contrarian and tend to be buying when everyone else wants to be selling, and selling when everyone else wants to be buying. So anywho, so that's that. Probably get that bounce off these levels we're at now. Like I said, a tradable bounce. And then, but the sell signals are intact, so that doesn't change anything. We could still likely go down to those targets I gave you a minute ago, which would be, well, any or all of these targets I gave you on IWM, with right now what I call max swing target. Even if this was the high of the bear market rally, and we are going lower, which, like I said, has a decent possibility right now. We're not going to go straight down, that I promise you. There are going to be plenty of buyers and plenty of tradable rallies along the way if that's the case. And like I said, if we have another thrust up here, there's still plenty of resistance overhead, not that far. Anywhere from that trend line would come in about 3% above current levels, and the 330 resistance on QQQ about 4%. All right, let's move off that. Enough on the equity markets. The other things I love that lumber trade, because I told you guys, I didn't mention it yesterday when I threw it out, but I did last week or 2 weeks ago. I read a while back that, and I knew it was coming out yesterday. I should have made mention of that. The new, I think it's LBS. It's the mini. They have a new lumber contract, and I'm going from memory here. Read the article and I talked about it back then. I think it's 1/8 of the size of this regular lumber. LB is usually a pretty good sized lumber contract, and the amount of lumber on LB, the futures, this is the one that's been trading forever, has been around for a long time. And it's the amount of lumber in there, I forget how many thousands of footboards of lumber it consists of. You can look that up. That's easy to find. But it has to be transported by rail car. And whereas the new contract is, again, I think it's an 1/8 of the amount of lumber, and it can be transported by truck, which allows for faster deliveries. It also allows for smaller hedging. Let's say For example, I mean, usually, almost always lumber futures are used for hedgers, for home builders, big home builder companies, Centex, Lennar, they might buy that to hedge against their costs. But now, individual, you're building a house, you could buy one of the little ones. I'm going to look it up for you real quick. Sorry, I should have had that ready. It's LB. Let me just type in lumber on another monitor. And LBR, that's what it is. And so the article, when I read it, was, oh, that's going to take money out of this and maybe bearish for this. I saw it the other way. I think it's going to bring a lot more people into the market. Because again, maybe you're building a house and you want to hedge up against the lumber costs, which is one of the biggest costs. It is the biggest material cost, I believe. Framing kits went when lumber started shooting up from like in the 15,000 to like 30. The increase was over $25,000 in some cases for a framing kit on a house. And so anyways, more people buying the smaller contract, it's raising the price of lumber, and so there's going to be arbitrage there. It's going to, you're going to see money coming into the big contract too, because again, that's still the same price as lumber's lumber. Maybe there'll be more volume. That's what they were saying in the smaller contract. So anyway, so far so good. 7% again today. Remember, this one was thrown out here. We undercut those recent lows, so it's rallied. And that again, here it is. Bull bear market thing. This is about an 18% rally in just a couple days here. So we're almost to that bull market designation, the antiquated bull market designation. But again, that's just the nature of the beast. Lumber goes up and down 40, 50, 60, 70, 80%, even in 90. I've seen it in a trend. It's a very volatile commodity, just like natural gas. So anyway, looking good. Still coming off that divergent low, but coming up to my next target here at 550, about 560. I'm actually going to clip some off there. I've got a few contracts. Let me pause the video and make sure my order is good to go here. Okay, just wanted to take off. Yeah, I did. Took half off right there. So that's it. About 560 there is resistance. Probably get a little reaction, but coming off that divergent low, we could certainly carry higher here. Next stop, well, you can see them 575, 50-ish, 603, almost 604, and so forth, so on. Any pullback to the 523-ish level would be an objective long entry or re-entry. And if the market really starts to roll hard, it could put some pressure. Lumber's kind of been marching to its own drumbeat, but if this is it for the rally in the market and we start to head down, pretty hard. I think there's going to be a crowded rush for the exits here. That may put a damper on lumber prices because a lot of folks been getting giddy, thinking the bear market's over. I'm sure there's been a lot of, and with that abatement in interest rates, moderating somewhat, of course. I'm sure there's been a surge of orders in new homes, and people second guess that when their 401k drops once again. So remember, what I'm trying to get at is stock market is a real-time leading indicator of consumer confidence. Just look where the stock market is. When you have a 20-30% drop, consumer sentiment's going to go right down with it because that's where most people, their 401ks and are flush and doing well, and all their investments, whether it's 401ks or not, they're out buying big TVs and boats and new cars and spending money, and then when it goes the other way, they tuck in the belt. All right, a couple other things I wanted to talk to you about and wrap this video up. I think I wanted to cover the hoofed creatures. They're doing well so far. No, actually, no. It's we're kind of about where we threw these out there: hogs and cattle, live cattle, lean hogs, and we're looking at LE here, live cattle, and we've got we're about to trigger a break of that trend line. So before I showed you, we had a divergent high here. That's what I pointed out, I believe, right here. And we went up, made a marginal new high, right? Had a little false breakout of this that resistance I had there at 144. Pretty decent resistance level. Resistance there, resistance, a big old gap right here. Reaction high, failed breakout, so aka bull trap. But what we need now, and I think we'll get it, is this break of the trend line right here. This is a 6-month, 2-hour candlestick chart, but there's our wedge pattern. That's the measured target right there, which is the widest part of the wedge, and that's going to take us down. So that would be and is my max target. I have the price support. My max target is a little bit below or above, I'm sorry, the measured target, about right about 137. Yeah, call that 137, and you can see the other targets along the way where we're likely to get some reactions. Cow was the ETN for that. It's thinly traded. It holds live cattle and lean hogs. And the others I've been highlighting lately. Crude continues to move up another 1%. It was up a little more today, but hit resistance. That's why I wanted to update on this. Is again short-term trading stuff. 10-minute chart, 2 weeks of price history. You've got some resistance here from 92.50 up to about 93. Remember, we're coming off a divergent low, both on this 10-minute chart as well as a more important 60-minute chart. I still have longer-term downside targets for crude, but again, I told you recently, the risk reward was favored being long instead of short, coming off that divergent low. And so far, it's we continue to rally, and you can also see the resistance here. I'm going to move this line up right now because we took it out, and you can see what I'm doing. I'm going to zoom in if you can't. Remember, I showed it to you on the 10-minute chart, but there's that resistance. I moved that line because a lot of these lines were targets on the way down, support levels. Support once broken becomes resistance, but you can see that fits better. So 92.59, and so it's been a decent rally off the lows so far, about 6%, and we'll probably get a pullback here, is my guess. And yeah, that's it. So I reversed it there based on that 10-minute chart, and I'm looking for a pullback to right about. I'm going to give you the different line here. I'm going to actually, I'll just leave that one there. It's more of a support zone right there. I think that's where we'll pull back to today at about 91, and then maybe just get out and sit and wait and see what happens, or look for the next objective short entry. Only other thing I'll mention is, crypto. I told you crypto is a correlated trade with the stock market. This is Ethereum, ETHUSDRR, the Ethereum futures. There's the downtrend line. We recently had a breakout, which I told you will probably prove to be a false breakout. As of now, it's not, because we can come in and still backtest this trend line and do that. But as I mentioned, we have this wedge type pattern forming. You had negative divergence, and it's been moving in near lockstep with the stock market. So if we get more downside in the market, which I suspect we will, then I think this breakout will fail. And as I like to say, fewer things in trading or in technical analysis are more bearish than a failed breakout. But it was also resistance. Remember, we have, we're a little bit above. Well, let's just call it a breakout right now. And if it fails, probably take us back down. And like the stock market, I think we have a potential for one more major leg down in crypto, and before we get a true washout move and a bottom where you can, a trend tradable bottom, meaning months. When I say swing trade, let's just say days to weeks. Sometimes a couple months there, 2-3 months maybe. Trend trading, we're looking out several months to years in trend trading. All right, I'm going to wrap it up here, get the video out to you guys, and I'll pick it up. If I see anything else, I'll throw a static post out, or some screenshots, on charts. This has been Randy Finney with Right Side of the Chart. Have a great day.